Hi everybody, and welcome back to video number 2 in chapter 23. When we left off, we were looking at major disclosures for fair values. And here, companies that have assets or liabilities measured at fair value must disclose both the cost and the fair value of all financial instruments in the notes to the financial statements. Fair value measurements may be used for many financial assets and liabilities, investments, impairments of long-lived assets, and some contingencies. Companies also provide disclosure information that enables users to determine the extent of usage of fair value and the inputs used to implement that fair value measurement. This fair value hierarchy identifies 3 broad levels related to the measurement of fair values, and we call those levels 1, 2, and 3. The levels indicate the reliability of the measurement of fair value information. You'll remember Appendix 16 Bravo discussed that detail for fair value disclosures in more depth. All right, major disclosures for revenue. Users carefully review revenue disclosures to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. Companies disclose information about 1. Contracts with customers, including significant information related to its performance obligation. Number 2, significant judgments and changes in these judgments that affect the determination of the transaction price, the allocation of the transaction price, and the determination of the timing of revenues. And number 3, the assets recognized from costs incurred to fulfill contracts, including the amount of amortization recognized and the method used for amortization. We discussed those issues in some depth in chapter 17. And now, major disclosures for deferred taxes, pensions, and leases. Here, the FASB also requires extensive disclosure in the areas of deferred taxes, pensions, and leases. We discussed in detail in chapters 18 and 20 through 20 each of those disclosures. Users of financial statements should carefully read notes to the financial statements for information about off-balance sheet commitments, future financing needs, and the quality of a company's earnings. We also have major disclosures for changes in accounting principles. The profession defines various types of accounting changes and establishes guides for reporting each type. Companies discuss, either in the summary of significant accounting policies or in the other notes, changes in accounting principles, as well as material changes in estimates and corrections of errors. We discussed that in chapter 21. All right, let's take a look at a review question. Which of the following should be disclosed in a summary of significant accounting policies? Alpha, types of executory contracts. Bravo, the amount of cumulative effect of change in accounting principle. Charlie, claims of equity holders. And Delta, depreciation method followed. And the answer here is going to be the depreciation method followed. Okay, Here we're going to discuss the disclosure requirements for related party transactions, post-balance sheet events, major business segments, and interim reporting. For related party transaction, 1, we'll take a look at the nature of the relationship or relationships involved. Number 2, we'll describe the transactions for each of the periods for which income statements are presented. Number 3, we'll take a look at the dollar amounts of the transactions for each of the periods for which income statements are presented, and 4, the amounts due from or to related parties. Here's a disclosure from Lyft Incorporated, and I'll let you read this on your own. But basically, they're showing the amounts purchased from these related parties and included in the consolidated statement of operations. And they say that those were immaterial. There are some other disclosures, of course, that they're making in this as well. Okay. So, a review question. If a business entity entered into certain related party transactions, it would be required to disclose all the following information except the alpha, nature of the relationship between the parties to the transactions; bravo, the nature of any future transactions planned between the parties and the terms involved; Charlie, a dollar amount of the transactions for each of the periods for which an income statement is presented; and delta, the amounts due from or to related parties as of the date of each statement of the financial position presented. And the correct answer is going to be bravo. The nature of any future transactions planned between the parties and the terms involved. These would be related party transactions. Okay, post-balance sheet events and commonly called subsequent events. So here's our financial period that ended December 31, 2025. And then here's our subsequent events period during the time the financial statements were issued. Okay. Events that provide additional evidence about conditions that existed at the balance sheet date, including the estimates inherent in the process of preparing the financial statements. These events require adjustments to the financial statements, and we're going to recognize those as the title indicated here, the subsequent events. Okay, alpha, settlements of litigation if the events that gave rise to the litigation took place prior to the balance sheet date. Bravo, warranty obligations if defects arose on products sold before the balance sheet date. And Charlie, a tax dispute related to taxes payable at the balance sheet date that is settled before issuance of the statements. Okay. Let's take a look at a recognized subsequent event example. Here, the facts are that a loss on accounts receivable results from a customer's bankruptcy subsequent to the balance sheet date, but before the financial statements are issued. The question, therefore, is how should this event be accounted for, if at all? And what we should do here, the company should adjust the financial statements before their issuance to reflect that loss. The bankruptcy stems from the customer's poor financial health existing at the balance sheet date. All right, now, non-recognized subsequent events. Here we're not going to require the adjustment of the financial statements. These are events that provide evidence about conditions that did not exist at the balance sheet date, but arose subsequent to that date. So, Alpha, strikes. Bravo, sales of a bond or capital stock issued. Charlie, a business combination occurs. Delta, a loss contingency related to litigation that arose after the balance sheet date. Echo, losses on receivables resulting from conditions arising after the balance sheet date. Foxtrot, changes in the quoted market prices of securities or foreign exchange rates. And Golf, entering into significant commitments or contingent liabilities. Okay, let's take a look at an example of a non-recognized subsequent event. Here, the company has a loss from fire or flood that occurred after the balance sheet date. How should this event be accounted for, if at all? And a fire or flood after the balance sheet date, but before the financial statements are issued, does not reflect conditions existing at the balance sheet date. The adjustment of the financial statements, therefore, is not necessary. Here, United Airlines is disclosing some subsequent events. And as we all know, there was COVID-19 that was reported in Wuhan, China. The World Health Organization declared that to be a public health emergency. That affected United Airlines quite a little bit. And the U.S. Department of State issued a level 4 do not travel advisory for China. And they implemented enhanced screenings, quarantines, travel restrictions, etc. The company suspended its flights between the United States and each of several Chinese cities in April 2020. Those routes represented 5% of the company's planned capacity, and the company's other trans-Pacific routes represented an additional 10% of the company's planned capacity. That's a big deal if you're United Airlines. So at the date of this report, the company is experiencing an approximately 100% decline in near-term demand to China, and approximately 75% decline in near-term demand for the rest of the company's trans-Pacific routes. So if the traffic on the company's trans-Pacific routes were to remain at these levels for an extended period, and or other routes in other parts of the company's network begin to see significant declines in demand, their results may be materially adversely affected. Okay, so here we're going to take a look at reporting for diversified conglomerate companies. Investors in investment analysis want income statement, balance sheet, and cash flow information on the individual segments that compose the total income figure. And here is a segment disclosure. This looks like a good place for us to stop this video, and when we return, we'll get into the Comcast Corporation's disclosure in more depth. Until that time, bye for now.